Good morning, everybody, and welcome to the MTRS, and thank you for taking the time to join us for our April Vacation Your MTRS Benefits presentation. Today, we'll be hearing from two members of the MTRS, Renee Chasson and Jennifer Catone, both Senior Retirement Specialists from Member Services North. I'm just going to go through a couple of housekeeping issues today. We do have a team of people ready to answer your questions in the live Q&A. On your screen, either at the top or the bottom, there should be a little button that looks like a question mark inside of a voice bubble. That'll open up the Q&A panel where you can chat with members of our MTRS retirement team in real time. We do ask, however, that you try to keep questions more on a general basis. We do not have the ability to answer your specific account-related questions over chat. You can always visit our website or call us for those type of questions. And also, please try to refrain from putting any personally identifiable information in the chat, such as Social Security numbers, member numbers, or anything else of that nature. So having said all of that, I am excited to introduce our first presenter, Jennifer Catone.
Hi, good morning. My name is Jennifer Catone, Catone. There's both ways. And I'm a senior retirement specialist here at the MTRS. I'll be presenting the first part of this presentation, and my colleague Renee Chasson will join us later on to present the second half. So just to give you an idea of what we're going to cover, part one will be an introduction to the MTRS, who we are and what we do. Part two will go over your membership and your annuity savings account. Part three will review membership eligibility, creditable service, and your benefits. Part four will go over how we calculate benefits, including formulas we use, the benefit options, and a few sample calculations. Part five will review retirement issues and things that you should consider before and after you retire. So this will be probably about an hour and a half long. So before we get into everything, I just want to go over one thing. We know that some people have created accounts online, and if you log in, sometimes you might see that there may be a delay or some missing information on your account. Please don't worry about this. These delays will not affect your retirement. This is just simply a delay on the back end of this particular system and getting certain information validated. Please let us know, though, if you do need an account summary for something like a court proceeding or something for your financial institution. If that's the case, we can definitely get something going for auditing your account and making sure that that information is up to date. But if you're not immediately retiring, you can request an audit of your service on our website. So as of April 2nd, 2012, Pension Reform 3 created a different benefit system for new members of Massachusetts public retirement systems. This means that members who joined on or after that date have their benefit determined by slightly different factors. Because of this, the MTRS has two membership tiers, where Tier 1 members are those who joined any Massachusetts public contributory retirement system before April 2nd, 2012, and Tier 2 members are those who joined on or after that date. This presentation is geared toward those members who joined before that date, but it will have a lot of helpful information for Tier 2 members who joined after that date. The examples that we show will be for Tier 1 members. If you're Tier 1, please remember that your benefit structure has not changed. Also, if you ever refunded your account from a Massachusetts public system and later rejoined on or after April 2nd, 2012, you are considered a Tier 2 member. Tier 2 members do use a different age factor, and they use 5-year salary average instead of a 3-year salary average that Tier 1 members use. What is the MTRS? So the MTRS is a defined benefit plan under Section 401A of the Internal Revenue Code. This means that your benefit is determined according to a set formula, and it's paid monthly for life. This formula is determined by your age, your years of service, and your salary. And fluctuations in the financial markets do not affect the amount of your benefit. And the pension fund is invested in a well-diversified portfolio with a focus on long-term returns. The MTRS is also governed by a 7-member unpaid board that meets monthly. And we have 2 offices, one in Charlestown, where Renee and I are, and one out in Springfield. Between the 2 offices, we have over 100 staff members. So members of the MTRS consist of Massachusetts public elementary, secondary, and charter and collaborative school teachers and administrators. All eligible employees are required to enroll and to make mandatory contributions. We'll talk about rates and how what you pay is determined a little bit later on. We are the largest of 104 Massachusetts contributory retirement systems. So what do we do for you? So when you join, we establish your annuity savings account when you join, and we maintain it throughout your career. We process any service purchases that you may want to make. We'll discuss those later on. We keep you informed about any retirement issues via seminars like this and broadcast emails. We'll refund your account upon request if you leave active service before you retire. We'll also discuss refunding later on. We'll process a benefit to your survivor if you die, and during your retirement, we'll pay you a monthly allowance, and we'll also pay a benefit to your survivor if applicable. So our website, mass.gov/MTRS, is your best resource. Here you can find any form that you might need, including service purchase applications, the retirement application, beneficiary designation forms, refund applications, and there's also a retirement benefit estimator. You can find also info on pending legislation as well, and you can join our email list to receive important updates. In your PDF booklet that you might be following along with, there's a general info email address, and you can email that address to be put on our list. So all members contribute a percentage of their earnings. Your contribution rate is based on when you join the MTRS. There's a giant chart on here. You can see the numbers and dates. I'm not going to read through the entire thing. You can look through it and see where you might fall. You can see the dates on the left and the rates on the right. One of the big dates is July 1st, 2001, when members who joined on this date were mandated into Retirement Plus and contribute a flat 11%. So there are two ways to be in R+. Either you were mandated by joining after 7/1/2001, or you were a member before that date and you elected into it. Also, if you were a member before that date and you refunded and then reestablished membership after July 1st, 2001, you'll be mandatory in Retirement Plus. So for rates that aren't Retirement Plus, most members here will probably be 8% or 9% or 11%. The 7, 8, or 9 is the percentage taken on your entire earnings. The additional 2% is additional taken only on your earnings above $30,000. So for example, if you earn $70,000 in a year, you would pay the 7, 8, or 9% on the entire $70,000. And then you would pay the additional 2% only on the additional $40,000 that's beyond the first $30,000. Members in Retirement Plus pay 11% on their entire earnings. So in the previous example, a Retirement Plus member will contribute 11% on the entire $70,000. An important thing to remember is that if you are 9% plus 2%, this does not make you a Retirement Plus member paying 11%, because this is one case where 9 plus 2 does not equal 11. So if you're looking at this chart and you're thinking there might be a problem with the rate that you're paying in, please talk to us or to your district's payroll officer. So you do contribute on your regular compensation. Regular compensation includes basically the things on the left side of this list, and things on the right side are not considered regular compensation. So your annual base salary that's listed in your collective bargaining agreement or your individual contract is always considered regular compensation, and you'll always be contributing on that. Other things that are considered regular compensation and eligible are regular longevity, which includes something maybe in your contract says that if you've worked for 10 years, you get an extra $1,000. If you've worked for 20 years, you get an extra $2,000. This is something in the contract and that is open to everybody who works in the district. There are options that some districts include that might be called elbow longevity or enhanced longevity or alternative longevity. This is a special longevity payment that you have to opt into, and this is not considered eligible. But what you can do is have the regular longevity that you would have received invoiced for the deductions, and you can use that in your salary average when it comes time to retire. Athletic and coaching and instruction. This is always considered eligible, and it does not have to be listed in the CBA as long as it is the instruction of athletics. This is something where you actually have to be coaching. It can't be something like timekeeping or taking tickets at an event. It also can be intramural. And additional annual payments for services pursuant to the CBA. This could be something such as you take care of the art club or the newspaper, something like that. As long as it's listed in the contract and it has an amount listed with it, it's eligible. On the right side, you might see hourly payments. I do want to give you the one exception to this for what is considered eligible is breakfast and lunch duty. So for these, you must be physically in the space with the kids. And you have to, so for that to be eligible, so you have to be in the space with them, and it has to be during regular school time. And these are considered eligible. So things that are not eligible and are excluded are amounts paid to your employer's knowledge of retirement. Say that it's some kind of retirement incentive where if you give them advance notice, you might get some kind of bonus. Sick leave buyback or unused sick pay buyout is not eligible. Same with unused vacation buyout. And hourly payments aside from the exceptions of breakfast and lunch duty that we mentioned. Also temporary salary augmentations. These are payments that are not built into your base. So say for 1 year you get a 1% bonus, but it's not built into your base for next year. That's not considered eligible. And then annuities and fringe benefits are things such as a cell phone reimbursement or travel allowance is not considered eligible. If you do see that you're having contributions taken on one of these excluded payments, you need to talk to your payroll office and see if you can get that straightened out. So your annuity savings account is the account that's created when you establish membership with the MTRS, and it contains all of the contributions that you have made and the accumulated interest along with the money paid for any service purchases that you might have made. If you leave service before retiring, you can take a refund on your annuity savings account. You can also leave your funds on account. Maybe you might return to teaching at a later date. So retirement benefits include your regular retirement or regular superannuation, a disability retirement, both ordinary and accidental, and a termination retirement. There is also an in-service death benefit, where if you die before you retired, your beneficiary can receive a benefit. So please do make sure to keep your beneficiary information up to date. So if you do take a refund, what will happen? If you leave the MTRS, you can take a refund of your annuity account. If you resign voluntarily and you have less than 10 years of service, you will receive all of the contributions you've made plus your annually compounded interest at a rate of 3%. If you have 10 or more years, then you receive all of your contributions plus interest at the regular rate. If you leave involuntarily or have an involuntary termination, you will receive all of your contributions plus interest at the regular rate, no matter how many years of service you have. And in all cases, you will only receive interest if you refund within 2 years of your separation from service. So just a few things to keep in mind if you do take a refund. It means that you then forfeit all of the things associated with your membership. So this means that if you later return to service and you decide to rejoin, you will be considered a new member and you will be tier 2. So you'll forfeit everything that has to do with tier 1, including the lower age factors and the 3-year salary average that you would have had as tier 1. So the age factors are different, and we use a 5-year salary average instead of 3 years for tier 2. So you will also have to work longer to receive a similar benefit than if you would remain a member. And the minimum age of retirement for tier 2 members is also increased from 55 years to 60 years. And even if you do repurchase that time that you refunded, it doesn't give you back your old status. So eligibility for tier 1 members, there are 2 superannuation retirement plans and they have different eligibility criteria. First is regular, where you can be any age with at least 20 years of creditable service or be at least age 55 with at least 10 years of creditable service. And then there's Retirement Plus if you're a participating member. So for Retirement Plus, you can be any age with at least 30 years of service, and at least 20 years of those must be membership service. Membership service is considered service with the MTRS or with the Boston Retirement System as a teacher. With Retirement Plus, you get an enhanced benefit with an additional 12% added to your base benefit percentage when you reach 30 years. And then you get an additional 2% for each full year after that. Okay, for disability retirements, there are two types of disability retirement, ordinary and accidental. First is ordinary. You may qualify for this if you have a pre-existing condition or if something happens to you that prevents you from doing your job. You have to have at least 10 years of service to qualify for this. And there are two ways of calculating this depending on whether you are a veteran. For non-veterans, it's the regular retirement formula with the age factor increased or bumped up to 55. For veterans, it's 50% of your last annual salary plus annuity. For this, your annuity is your account balance times the actuarial factor. This only really benefits you if you aren't yet 55 or if you're tier 2, if you're not yet 60. The second type is accidental disability. You can qualify for this if you're injured on the job. There's no service or age requirement, and your disability must have been due to injury or accident while performing your job duties. The formula for this benefit is 72% of your last annual salary plus annuity. For both types of disability retirement, the applications go through an extensive legal review and then they must be approved. And this takes a long time to process. So we usually suggest that you go first through with a regular retirement process while your disability retirement is under review. This way you'll still receive a benefit while your disability retirement is pending. So next is termination retirements. Termination retirements are only available for tier 1 members. So if you're tier 2, you can't get a termination retirement. The requirement for this is at least 20 years of service, and your termination must be completely involuntary. This means for something, for example, your position was eliminated or you weren't reappointed. You cannot have been fired for cause. The benefit formula for termination retirement is your 3-year salary average times 1/3 plus your annuity. Your annuity in this case, again, is your account balance times an actuarial factor, and this equals your option A benefit. Termination retirements usually end up being around 45%. And for them, you also must complete a termination statement and release. So next we're going to talk about creditable service. Regular service for a full-time teacher is usually 10 months for 1 year. If you're on a 12-month contract, 1 year will be 12 months. This is because teachers usually work September through June. That's 10 months, so that's why 10 months is 1 year. And administrators usually are on 12-month contracts, meaning they work July through June, which is 12 months. So for them, a year is 12 months. And as long as you work that full year, you'll receive a full year of credit. If you have a leave of absence, paid or unpaid, it's considered regular service, and you can get up to a month of service credit for a documented approved leave of absence. The next section is about part-time membership service. So please remember, this is only regarding membership service, and membership service is service where you're at least 50%, you're licensed, you're in a position requiring licensure, and you're paid according to a contract. So these rules do not apply if you're doing other service that is less than 50% or something like a substitute or non-membership position. So please ignore this if this is what you think, if this is what you're, if you were 30% or something like that. So if your part-time service was rendered on or before November 9th, 1990, you will receive full-time credit equivalency. So this means, for example, that if you are 60% for the 1987 to 88 school year and you work the full year, you'll receive a full year of service credit for that year. The period between November 9th, 1990 and July 9th, 2010 is a little bit different. If you were part-time during this period and you never went to full-time, even just for a day or a week, then you will receive full-time credit during this period. And for service rendered on or after July 9th, 2010, this is always prorated. So please see, I think it's page 34 in your PDF for a really thorough breakdown of this and some examples. And another issue affected by this prorated credit is kindergarten service or pre-kindergarten service. For service before that second date of July 9th, 2010, all kindergarten and pre-kindergarten service is full credit. But you have to have been in an actual teaching position. This couldn't have been something where, say, you were a speech language pathologist and you worked in a kindergarten classroom. You actually would have had to have been a kindergarten or pre-K teacher. And if you are part-time when you retire, or you are part-time during one of your last 3 years, you won't be double penalized for this. We'll calculate your salary average using the full 100% salary rate in your salary average. Purchasable service. So this slide here tells you about how to purchase service. It'll review the types of service that you can purchase. So again, we said that there are 104 Massachusetts contributory retirement boards, and you may have taken a refund from any one of them. So this is a list of ones that are billed at the actuarial interest rate. This is currently 7%. So those refund buybacks are billed at 7%. Massachusetts state or municipal employment. This could be something working for a local government. Say you were a lifeguard over the summer, or you worked in an office for your local town. Out-of-state public school teaching. This is the only service purchase application that has 3 parts. So one of those parts is going to have to be filled out by the retirement system that oversaw the district where you taught. Non-public school teaching, which is from pre-1973 in a private school. This is different from another type of non-public teaching service, and we don't really see many of these applications anymore. Department of Defense oversees dependent school teaching. This is teaching that is out of the country, and it's usually on a military base, and it will require federal documentation. So the next set of purchases is covered under Section 4 of the law, and it's billed at the buyback interest rate, which is currently 3.5%. It's half of the actuarial rate. So military service. You must meet the Massachusetts definition of a veteran to purchase this service, and you will need to submit a DD-214 form. Non-public teaching in a Massachusetts publicly funded school. This must be teaching service, and the school must have received funding from the state or community. This is one of our most extensively reviewed applications, and it can take a while to process. And vocational education or Chapter 74 trade service. This is the 3 years prior to getting your license. And then also Peace Corps service. This is, again, Peace Corps and not AmeriCorps. So how do I purchase service? You can talk to us, or you can see the first page of each application for an eligibility checklist. Download the service purchase forms on our website, mass.gov/MTRS, and go to forms. And most applications will have 2 parts. You'll complete the first part, and your former or current employer, depending where you worked, will complete the second part. And again, if you're submitting an out-of-state application, there is a third part that must be completed by the retirement board that oversaw your employer as well. All signatures must be wet signatures, so you can fill it out online, just type everything into the PDF, but you do need to print it out and sign it in pen. We can't accept digital signatures. We cannot accept digital signatures, sorry. You'll then submit the application to the MTRS for processing, and we will send you an invoice. The cost is first calculated typically as your earnings multiplied by the contribution rate, and the cost will typically include interest that is compounded annually. There are special formulas for certain purchases, such as vocational and military. And if you pay by check, this will be a post-tax payment, so you will not be taxed twice on this at retirement. You can make a rollover from an eligible pre-tax plan. This would be something like a 401k or a 403b, or maybe you contributed to OBRE before you started teaching in the schools. And if you roll over, this will be a pre-tax payment. You can also decide to pay with our 5-year installment plan, but please remember that this must be paid off before your retirement dates. Some types of purchases do have a higher volume of applications than others, and so they therefore take longer to process, so we do ask that you please be patient. And a few important reminders, in order to purchase service, you must be active at the time of your application or on an approved leave of absence of up to a year. There are exceptions to this. Those are Peace Corps service and refund buybacks. These you do not need to be active for. And also with a vocational service application, these must be purchased at the time they're invoiced. You have 180 days to pay for these, and they must be paid for within that 180 days because they can't be re-invoiced at a later date. So if you do receive an invoice for this and decide you don't want to buy it yet, and then in a couple of years decide you're ready to make that payment, we can't do that for you. You would have had to pay at that time. And again, all service must be paid in full by your retirement date for it to apply to your retirement. And late payments will mean that we might need to push back your date of retirement or delay your first check. And so with that, I finished my part. I'm going to pass everything over to Renee.
Thank you, Jen. My name is Renee Chasen, and I will be bringing us through the remainder of the presentation. So first, we will go over benefit options. There are 3 benefit options for your retirement. Please note that this is the most important decision you will make for your retirement. This decision is individual to you and your situation. There is not a one-size-fits-all. So there is a set benefit formula that Jen previously touched on. It is your age, which has a corresponding age factor, multiplied by your total credible service years, and that gives us your base percentage. There is an 80% maximum for the base benefit, but note your base percentage is your personal maximum. Option A, the retiree benefit amount is that maximum allowance or that maximum base benefit. There are no survivor benefits, with the exception of a month of death check. So if you were to pass away on the 15th, you have earned 15 days of retirement pay. So your beneficiary would receive a one-time lump sum pay of that 15 days. For option B, it is approximately 1 to 3% less than the option A amount. And there is a one-time lump sum payment of balance, if any, for your survivor's benefit. There are no restrictions on your option B beneficiary designation. This is our least popular option due to that, if any, remaining in the retiree's account. So your annuity savings account, which is made up of the contributions that you make monthly, lasts about 9 to 11 years after retirement. Your benefit that you receive monthly as a retiree is an 80-20 split. So 80% comes from the state pension reserve and 20% comes from your annuity savings account. So each month, your annuity savings account is depleting as you are being paid. This option is most popular for terminally ill members, older members, or members that can take that 1 to 3% difference. It is a nice option to kind of safeguard your annuity savings account. But again, if you are to live past that 9 to 11 year estimate, like we are all hoping to, then you are receiving that 1 to 3% decrease for the remainder of your life. And our last option is option C. So for the retiree benefit amount is approximately 9 to 11% less than the option A amount. This 9 to 11% decrease in your base benefit is dependent on who you are naming as your beneficiary. If you choose a spouse that is near you in age, it'll be closer to that 9%. But if you are to choose a child that is 30 years younger than you, it will be more. For the survivor benefit upon retiree's death, the beneficiary receives a monthly benefit equal to 2/3 of the retiree's benefit for the remainder of their life. There is a chart to see that percentage for the option C on page 36 of the PDF booklet you received. There are restrictions on option C beneficiaries. It must be either a child, spouse, former spouse, not remarried, parent, or a sibling. If your beneficiary were to pass away prior to you under option C, you automatically pop up to option A as of the beneficiary's date of death. So that is that pop-up provision noted on option C. Just a quick fact, option A is our most popular benefit. Page 13 of the PDF booklet notes what the class of 2024 chose regarding their option. So we touched on that retirement formula previously. This is it just laid out for you to see. So we take your age factor at retirement or the closest age at retirement for option C, and we multiply that by your credible service. For your credible service amount, we do use full years and full months. Multiplying these two gives us your base percentage of salary average. We then take that and add retirement plus, if applicable. That is that additional 12% at 30 years plus 2% for each full year thereafter that Jen had mentioned previously. Adding these two, we get your total percentage of your salary average, and that is that 80% maximum. Again, your personal maximum may be different. We take that percentage and multiply that by your salary average, your 3 highest consecutive years, and we get your option A annual benefit. We add a veteran's benefit if applicable, and that is $15 per year of credible service with a $300 maximum. Adding these two, we get your total option A annual allowance. Now we are going to go over some examples. I have two for you. Just keep in mind again that these are for tier 1 members. If you are tier 2, it is still helpful to see, but know that your benefit formula is a little different. So Mary Educator is retiring on 6/30/2025. She is not participating in Retirement Plus. Her age is 59, so her corresponding age factor is 0.019. Her credible service totals 35 years even. She has regular service in Pittsfield for 30 years. She purchased 4 years of out-of-state service in Kentucky. She purchased 0.4 years of substitute service in Springfield. And then she purchased 0.6 years of other mass service in the Parks and Rec department. Her salary average is total $75,000. So her last 3 years, for 22-23, she earned $73,000, 23-24, $75,000, and 24-25, $77,000. Her total of the 3 years is $225,000. We divide that by 3 to get her salary average of $75,000. In Mary's case, her last 3 are her highest consecutive years. Please note this is not always the case. For instance, if you took on an admin role for a little bit and then went back to teaching for your last couple of years, we may not be using your last 3 years. We may be using those admin years that might be a little higher. Mary Educator is a veteran. So now we're going to take all of those numbers and plug that into that formula that we just went over. So her age factor was 59 at retirement, so 0.019 multiplied by her years of credible service, 35. And we get her base percentage of salary average of 66.5%. Multiply that by her salary average of 75,000, and we get her option A annual benefit of $49,875. She was a veteran and she is getting that $300 max. So her total option A allowance is $50,175 a year or $4,181 a month. One thing to note is we do break it up by year and month because retirees are paid once a month on the last business day of every month. This might be a little different. Currently, you might be receiving biweekly pay, sometimes even weekly. So just keep that in mind for budgeting. Now we'll go over Mary Educator's option B. So her option A allowance was $50,175 a year. Her option B allowance is $49,707 a year. How do we arrive at that figure of $49,707 a year for Mary? It is based on what is in your annuity savings account and your age at retirement. So for Mary Educator, her option B is less by $468 a year, a difference of less than 1 to 3%. So for option B, remember there is a 9 to 11 year spend down for option B. If you live past that 9 to 11 years, you will have this benefit reduction. So in Mary Educator's case, that $468 reduction every year forever with no beneficiary. For option C, so for that option C factor, it is based on the member and beneficiary's ages closer to the member's date of retirement. This is unique to option C and is the only instance in which we do that. So Mary Educator's closer age is 60. Her beneficiary's closer age is 59. So using those two ages on that chart, it's probably super tiny on your screen. We get her option C factor of 0.9099. There is this beneficiary option C age factor chart on page 31 of the PDF you received. Again, under option A and B, we use her actual age of retirement, which was 59 for Mary Educator. But under option C, we are using her closer age at retirement. So if your birthday is within 6 months of your retirement date, we can use that higher age only under option C. So plugging in that option C factor, we take her option A annual benefit of $49,875 a year, multiplied by her option C factor of 0.9099, and we get her option C annual benefit of $45,381. She was that veteran, so we add that veteran benefit, and we get her option C allowance of $45,681 a year, or $3,807 a month. For her beneficiary, we take that amount and multiply it by 2/3 to get her survivor's allowance of $30,454 a year, or $2,538 a month. Her survivor will receive this amount until they pass. Again, I previously mentioned with option C, there is a pop-up provision. So if your survivor passes before you, you will automatically pop up to option A as of the beneficiary's date of death. Another example for you is Tom Teacher. He is participating in Retirement Plus, and he's retiring on 6/30/2025. His age is 58, so his age factor is 0.018. His credible service is 34.5 years. His salary average is $75,000, and he is not a veteran. So taking those numbers and plugging them into that formula, 0.018 multiplied by his 34.5 years, we get his base percentage of salary average of 62.1%. He is in Retirement Plus, so he is getting that additional Retirement Plus bump, which for him is 20%. Adding these two up, we do hit that 80% max, so his total percentage of salary average is capped at 80%. Take that multiplied by his salary average, which is $75,000, and we get his option A annual benefit of $60,000. He does not have that veteran's benefit, so his total option A allowance is $60,000 a year, or $5,000 a month. If you were to pass while being an active member with the MTRS, we do offer in-service death benefits to beneficiaries or a beneficiary. Keep the MTRS up to date with life events, marriage, a child, or divorce. So there are two options that you can receive for in-service death benefits: a one-time lump sum distribution of your annuity savings account, or a monthly member survivor benefit. This is calculated the same as option C with no reduction. Your age factor is increased to 55 if you are under 55, and your dependent children do receive allowance, $120 a month to the eldest child and $90 a month for each additional child. This is payable until age 18 or 22 if a full-time student. Again, keep your MTRS beneficiary designation current. Let us know if you have any life updates, marriage, divorce, a child. We do have a one-page beneficiary form on our website. Keep it current. It is super simple to fill out. If you are terminally ill, please reach out to us to walk you through your options and what may be best for you. We will now touch on health insurance. So there are two ways that someone can receive retiree health insurance. It is either going to come to you from the GIC, which is the Group Insurance Commission, or from your city or town directly. Within the GIC, there are two ways to qualify. First, if your city or town participates in the RMT program, which is the Retired Municipal Teachers Program, this means you will have health insurance through the GIC at the RMT rates. On page 19 of your booklet, there is a list of the districts that participate in this. The other way is to have health insurance through the GIC municipality program. This means you will currently have health insurance through the GIC as an active teacher, and this means that you will have GIC insurance as a retiree. You should check to see if the retiree health insurance is any different from the current health insurance you may have as an active teacher. The plans may change, or the cost may change once you become a retiree, so reach out to your school to confirm. If you don't have health insurance through the GIC, then you should have health insurance directly through your city or town. Once again, please check with your local insurance coordinator regarding the provider, coverage, and costs. Look into survivor health insurance. Will your health insurance continue to cover your family if you were to pass away? And if you qualify for Medicare, find out how that affects your health insurance. What's covered and what isn't. To qualify for Medicare, you must meet one of the 3 following eligibility requirements. First, if you qualify for a Social Security benefit, you qualify. If you're married to someone who is Medicare eligible, you qualify through your spouse. And lastly, if you changed employers starting after 4/1/86, you have been paying a 1.45% Medicare tax, and you have paid that Medicare. If you have paid that Medicare tax for 10 or more years, that will make you eligible as well. Things you need to investigate if you're eligible for Medicare. Ask if there is supplemental insurance offered through the city or town that you can purchase. This will often cover things Medicare will not. It is also called Medigap because it fills in any gap that Medicare might leave. Last point here on the slide, avoid penalties before your 65th birthday. Contact Social Security to determine your eligibility for Medicare and when you need to apply for Medicare Part B. Medicare Part B covers generic care and doctor's visits, but a lot of people don't sign up for this because they do not know what it is or they think they do not need it. We've been told that there is a 10% surcharge every year after your 65th birthday, so make sure to reach out to Social Security. We will now touch on working after retirement. So there are no limits on the following: employment in the private sector, employment in another state, public or private, and employment within the federal government. Excuse me. If you are working in the Mass public sector, there are general time and earning limitations on reemployment in the Mass public sector. If you're returning to the same employer from which you retired, you must be separated from service for 60 days before returning. This is waived if you're retiring at 62 or above, or at that 80% maximum benefit. If you are retiring at the end of the school year, June 30th, and then planning on coming back September at the start of the year, that 60-day requirement is met with the summer break. Then there are time and earnings limitations. For time, your service cannot exceed 1,200 hours in a calendar year. Please note calendar year is January to December. For earnings, there are post-retirement earnings, which cannot exceed the difference between the salary being paid for the position from which you retired and the amount of your annual pension. After you have been retired for one full January to December calendar year, this limit is increased by $15,000. Please note, for time and earnings limitations, it is whichever you hit first, not both. So for that last slide, talking about your earnings restrictions, this kind of puts it into an example for you to see. I know it was a lot of verbiage. Mary Educator is retiring on 6/30/25 from a position that paid $77,000. So had she stayed in that position, the 25-26 school year salary would have been $79,000. We take Mary's annual gross MTRS pension, subtracted from that $79,000, and we get her allowable earnings for the rest of calendar year 2025 to be $28,825 a year. Beginning January 1st, 2027, so one full calendar year after, Mary may earn an additional $15,000 per year. For the salary for that former position, the salary includes earnings such as regular longevity, coaching, and contracted stipends. There are different rules in the event of an ESE-approved critical shortage waiver. A critical shortage waiver is used when a district posts a position cannot find a candidate, and applies for a waiver to have a retiree fill the position. The different rules include Retirement Plus retirees must wait 2 years to be eligible for a critical shortage waiver. The school district must apply to the ESE to obtain a 1-year waiver for a specific position. This 1-year waiver must be done every year. They are not for an indefinite amount of time. If the above are met, the retiree may work without earnings limitations for the duration of the critical shortage waiver. We will now touch on the taxation of your benefit. Your retirement allowance is not subject to Massachusetts state income tax, but it is federally taxable. Many of you will have slightly reduced taxable earnings each year because of post-tax or after-tax dollars in your annuity savings account at the time of your retirement. Post-tax or after-tax dollars include pre-1988 deductions and purchases made with after-tax money, so such as personal checks. If you intend to move out of state, check with that Department of Revenue in that state to determine if your retirement allowance is subject to state income tax. For example, Maine will tax you, but Hawaii will not. By January 31st of each year, we will mail you a 1099-R tax form. This is the retiree version of your W-2 form. On your 1099 form, we will separate the after-tax portion on this with the taxable portion so that you will not be double taxed. This is also why you will want to keep your address up to date in your account, as we do send things out via mail. And on the last note, every other year, the MTRS will send you a benefit verification form to prevent pension fraud. Your signature and a witness signature are required. This is just to prove you're alive and receiving your pension benefit verification. If not completed, your benefit will be paused. This previously applied to all MTRS retirees, but it has recently changed to only retirees that live outside of Massachusetts. Now touching on Social Security. Previously, there were 2 different offsets that affected Social Security, but on January 5th of this year, President Biden signed into law the Social Security Fairness Act. This repealed the windfall elimination provision, WEP, and the government pension offset, the GPO. This law has a retroactive date of January 1st, 2024, which means that the Social Security Administration will be required to recalculate benefits for anyone impacted during 2024. Please note, we do not administer Social Security benefits, so if you have any questions or concerns, you will want to reach out to the SSA. The Social Security Administration will need time to implement the changes into law and process recalculations. To stay informed on this topic, go to ssa.gov and subscribe to receive updates directly from them. And we will also continue to share updates on our website, mass.gov/MTRS. One thing to note is Social Security will never affect your pension. Now on a happy note, cost of living adjustments. Mass public retirees are eligible for cost of living adjustments after 1 full fiscal year of retirement. This is July to June. It is granted by the legislature as part of the annual budget process. While usually approved, a COLA is subject to approval by the vote of the Mass legislature. The amount is currently 3% or the CPI, whichever is less on the first $13,000 of your retirement allowance, for a maximum increase of $390 per year. This is compounded annually, so your retirement allowance will not decrease at any point, but may increase through cost of living adjustments. This brings us through to the end of the presentation. For more information, please go to our website. It is super helpful, mass.gov/MTRS. You can also call our 2 offices in Charlestown and Springfield. And if you have any remaining questions, please utilize that chat box. Thank you and have a wonderful April break.